Hi, good evening, everyone. If you guys can hear me, please just say something in the chat so I know that the audio is working okay. Okay, so to get started, my name is Theo. I'm a popular investor on eToro. I guess most of you already know that because there's quite a few people copying my portfolio at the moment. So today's video is going to be a presentation about two topics. The first will be how I manage risk in my portfolio. And the second will be an analysis of Sanderson Farms, which is one of the companies that I'm holding at the moment. I hope you'll find this interesting. So I'm just going to flip over to the presentation. I will take some questions at the end, and then let's see how this goes. Okay, let's get started. First, a very quick disclaimer. This is only for educational purposes and is not an investment advice. All these opinions are purely my own, and they are not affiliated nor endorsed by eToro. Of course, trading may result in the loss of your capital, and you should consult a certified financial advisor to discuss your personal financial circumstances and the suitability of any investment product, including my copy portfolio. And of course, past performance may not be indicative of future results. So if you have watched my previous investor update, I went into a lot of detail about my goals and my strategy for achieving those goals. But basically, my objective is to beat the S&P 500 by an annualized 5% in any rolling 5-year period. So to do that, I have 4 key themes which I invest around, which are the rise of China, luxury goods, the enduring power of big technology, and what I believe will be a very bullish next couple of years for the entertainment industry. So collectively, these 4 themes, which are the strategies that I use to try and outperform the S&P 500, comprise about 66 to 75% of my portfolio. Now, you might be wondering, what is the rest of the portfolio about? And that's the topic of today's video. I use the remaining 1/4 to 1/3 of the portfolio to manage risk. Now, when you're choosing an investment, whether that's a stock or a copy portfolio like mine, the absolute returns are important, but what's more important are the risk-adjusted returns. So if you are going to deliver, let's say, a return of 25% in a year, there's a certain amount of risk that's appropriate to take to achieve that return. So given that my objective is to beat the S&P 500 by 5%, clearly I need to be up the risk curve from ETFs. However, I don't need to be taking crazy risks. So I've set a target for myself for a 20% annual volatility in my portfolio, which if you've ever studied modern portfolio theory, that's how you measure risk, is the volatility from of the month-to-month returns or year-to-year returns. So far, so good. To date, in the past 12 months, I'm up approximately 80%, even after the drawdowns in the NASDAQ last week. And most importantly to me, it's not the percentage return, but the fact that I've been able to maintain fairly reasonable drawdowns well below my target. So how do I actually go about managing risk? Well, the first one is exposure management. So I have these 4 themes in my portfolio: again, China, entertainment, luxury, big tech. And on a weekly basis, I evaluate what percentage of my portfolio is exposed to each idea. And I start adjusting if I realize that I'm out of my predefined ranges. And if I'm not going to go into this in detail in this presentation because I've covered it in extensive detail in my previous one. So if you're interested, you can go check that out. What I will be talking about today are my hedging positions. So my hedging positions are that remaining 25 to 33% of my portfolio. Now there's 2 kinds of hedges. The first one are negatively correlated positions. So these are hedging investments that move in the opposite direction of the main stock that you're investing in. And there's a whole bunch of different types of hedging positions, from long short pairs where you pick two stocks that move almost in the same directions. They have an almost perfect correlation. You take a long position in one and a short position in the other, and you're hoping to make money from the relative performance between those two instruments. Next, eToro, of course, has some very direct hedges in the terms of the UVXY, which is the Ultra Shares Extreme Short ETF, as well as a derivative of the VIX, which is a measure of volatility. And the final thing, which I do occasionally, is I short indexes on a particularly bumpy day, not in a 50-50 ratio with my stocks, usually much less. And usually my goal there is just to take the edge off a particularly nasty day in the markets. But what I'll be talking about today, primarily, and the reason that I've chosen to analyze Sanderson Farms in this presentation, is uncorrelated positions. So these are stocks or other instruments that move in completely random directions from your main portfolio. And this is considered to be one of the best ways to hedge portfolio risk and to reduce drawdowns. Because of course, if one of your positions, your main positions, is down, more often than not, an uncorrelated position might be up or might be flat. So the first thing to test before I even get into the stock is, are chickens in fact negatively or weakly correlated with my key investment themes? So in this chart, you can see the statistical correlation between Sanderson Farms and one representative stock of each of my 4 investment themes, plus the benchmark that I've chosen. Now remember, statistical correlation is a number between -1, which would be perfectly negatively correlated, up until +1, which means they're perfectly correlated, which means they move exactly up and down in the same direction. And in the middle, 0 is uncorrelated. They move in completely random directions from each other. So as you can see in the numbers here, chickens are highly uncorrelated to my 4 investment ideas, and that's primarily why I hold them in my portfolio as a risk management tool. However, being uncorrelated doesn't mean that they are actually low risk, and it doesn't mean that they're low returns either. I'm not sure if you'll be able to read this over the stream, but if not, I'll just point out a few key things. So between Sanderson Farms and the S&P 500, the annualized return over the last 20 years for Sanderson Farms was 18%, which is almost 3 times higher than the S&P 500 in that same time. So Sanderson Farms is actually a very high performing stock over the past 2 decades. Now, if that 6.5% number feels intuitively low to you, you have to remember this is a 20-year period. So this includes the dot-com crash and the 2 years of bear market that we had following it. And it also includes the great financial crisis in 2008 and another 2 years of bear market following that. However, on the downside, the risk, which is again measured by standard deviation or portfolio variance on the S&P 500, is 15%, while for Sanderson Farms, it's 35%. So chickens can be an extremely lucrative asset, but they are also extremely risky. They're twice as risky as the S&P 500, more than twice, in fact. And they are more risky than the overall portfolio risk I want to take. So let me just switch views here for one sec. Okay, I'm going to move onwards. And this chart shows the prices of chickens from an inflation perspective. And you can see they vary pretty wildly from year to year, how much the price goes up or goes down. Now, if you happen to know a little bit of the history of, let's say, the S&P 500 in the past 20 years, if you look, for example, at 2008, 2009, when all the markets were crashing, it was a massive pullback in the stock markets of almost 50%, chicken prices were up. And again, this is kind of reinforcing the fact that chickens are a very low correlation investment to our main stock indexes. Now, why is that? Because people don't actually eat a whole lot more or a whole lot less chicken every year. A lot of it has to do with the fact that chickens, they love to eat. And the feed that we give to chickens is primarily made of soybean and corn. These are both what are called primary commodities. So, they're farmed and then sold in the futures markets all around the world. But that means that chickens are highly reliant on the price of both commodities. So in order to predict and understand the price of chicken, you have to first predict and understand the price of soybeans and corn before you can grow a chicken to the size where it can be turned into a delicious chicken wing. Now let me go over to Sanderson Farms. Just start very quickly with a quick snapshot of the company. It is the third largest chicken producer in the United States, and the United States is the largest chicken producer in the world on a country basis. The company is primarily based in the south and southeastern part of the United States between Texas, Mississippi, Georgia, and North Carolina. It operates the entire value chain. So they have chick hatcheries, they have chicken farms, and then they have processing plants where they do some value-added activities like packaging and preparing the chicken for retail sales, for example. Excuse me. Now, if you've been following the news in the past couple of weeks, you'll know that these are pretty much the areas that were hit by a huge winter storm. Texas had record low temperatures, dropping down to something like minus 20 degrees Celsius. This worried me quite a bit because I was already invested at Sanderson at that point in time. So I did some research, and it turns out that chickens are extremely robust. When it gets too cold, they bunch together and they keep each other warm. Sanderson Farms subsequently released an update to investors saying that the chickens were fine. They had lost about 1%, of their annual chicken yield, which is really not too bad. Just in terms of the competition, so again, they're the third biggest, so it's worth noting that they are among the big chicken producers. They make the biggest size chickens, weighing an average of 8 pounds, which is, I think, about 4 kilos or so, 3.75 kilos. Their most direct competitor, which is also available on eToro, is Pilgrim's Pride. That is also a pure chicken manufacturer, which is about 3 times bigger than Sanderson. The biggest producer in the space is Tyson, but I don't really like studying it or investing in it because it's actually a multi-meat conglomerate. So they have chicken, but they also have other types of food. And then there are two private companies, which are so private, they're obviously not listed, which are Koch Foods and Purdue. It's worth probably pointing out that the owners of both those companies are multi-billionaires. So there's definitely some good money to be made in chickens. Okay, so that's a quick snapshot of what Sanderson is. Let's go into the actual investment thesis. Why do I hold this company in the portfolio? Besides wanting to have an uncorrelated hedge against my main investment themes. So I think the most obvious answer is Sanderson Farms is the most efficiently operated chicken manufacturer in the United States. It has a 3% operating profit margin, which doesn't sound very high and is not very high if you look at, let's say, a tech company or many other companies. But commodity companies tend to work on very small margins, and so 3% is quite significant. In fact, it's 3 times the operating margin of its direct competitor, Pilgrim's Pride. Now, Sanderson Farms is an expensive chicken stock. It is trading at a 19 forward PE ratio, so in other words, today's price relative to the forecasted earnings for next year, whereas Pilgrim's Pride is only trading at a 11 forward PE ratio. So pound for pound of chicken, Pilgrim's Pride is a cheaper company than Sanderson. Price book is another ratio you can look at, and it tells us the same story again. Now, the first kind of astonishing number that you might see here is the PEG ratio. So the PEG ratio, it means price earnings growth. That is a measure of how fast a company's profits are expected to grow relative to the share price. So a 0.2 PEG ratio basically means that profits are expected to grow 5 times faster than share price in the 5 years ahead, which of course is either going to drive the PE ratio way down, or more likely, it's going to drive the valuation of the company up. And 0.2 is a phenomenally low number. With many tech companies, that number is over 1, which is the opposite. That means the share price is growing faster than the profits. That's putting pressure on the company to sustain its ongoing PE ratio. Something else I really like about Sanderson Farms as a company, it's extremely diversified. So it sells everything from supermarket chickens to restaurant chickens to home, like prepared home delivery style chickens. And during the COVID pandemic, when the restaurant business shut down, Sanderson was very quickly able to pivot its business over towards supermarkets where there was suddenly a huge spike in demand as people started cooking from home. And that turned out to be a very good competitive advantage. So when most other chicken producers were suffering last year because they were very rigid in their supply chains, Sanderson was blooming. Okay, so the company has been growing at a fairly consistent pace for the past 23 years. It's during that time only had one dip in 2009, but it has been processing more and more chickens. It's worth noting that the average increase in chicken consumption in the United States only goes up by about 2% per year, 1 to 2% per year, which means that anything that you see here that's over 1 or 2% ultimately represents a gain in market share because they are growing faster than the industry that they are in. If you've seen my previous video about Thor Industries, you know that one of the most important things to look for when you're investing in stocks are catalysts. So these are events that could be short-term events or long-term events, which could fundamentally move the share price. I've identified 4 catalysts that I think are likely for Sanderson Farms, or at least very plausible in the coming 12 months. Now, the first one is very simple. So I joined the Sanderson Farms investor call last week, the live call where they give an update about their earnings. The CEO is named Mr. Sanderson. He's a elderly Texan who speaks with a very thick Texan accent. It sounds like he has his mouth full of chewing tobacco. It's actually quite hard to understand what he's saying. But this is not Elon Musk tweeting about Dogecoin. This is a very conservative management that is very cautious about what kind of forecasts they give to the market. And for some reason, Wall Street analysts just don't like this company. And they haven't liked this company for a long time. So I've pulled this chart that you can see here from eToro. It's in the analysis section of the company stock. You can see that the consensus of Wall Street analysts are saying that this stock will go absolutely nowhere in the next 12 months. In fact, the average price target for 12 months is exactly the same as today's actual price. There's 1 or 2 more bullish analysts, and there's several that are much more bearish about the prospects for Sanderson. So that's fine if the analysts are right. But when I started studying the stocks, one of the very first things I noticed is that they were comically wrong about Sanderson. They have been for a long time. So when a company reports earnings, whether its stock goes up or down afterwards is not necessarily whether they made a profit or a loss, but it's how they stacked up against the expectations of investors, or the expectations often of Wall Street analysts who research these stocks. So if Apple, for example, says in 2 months from now, hey, we just had a profitable quarter, that's not going to change the stock price because everyone knows Apple will be profitable. Now, if you look at this chart at the bottom, you see how comically inept Wall Street analysts have been in understanding the stock. In Q2 of 2020, Sanderson outperformed Wall Street expectations by 2,000%. In Q3, by 1,600% on an earnings per share basis. And in Q4, which just finished, by 200%. So what this tells me is that analysts absolutely don't understand how to value the stock, and that the estimates they make about it are wildly wrong and inept, which is fine by me because that means we have an opportunity to perhaps see value in the stock where they don't. Next, so even though Sanderson actually grew during 2020, they grew during the pandemic, something that most analysis that I read didn't really pick up on is the fact they suffered while they grew. So they have a huge restaurant business, both in fast food as well as in kind of mid-market chains like Buffalo Wild Wings or Dickey's Barbecue Pit, which if you're ever in the United States is well worth eating at. It's really delicious. So these two segments have obviously been hit very hard by the pandemic, and many of their chains and stores have been closed for the past year and are slowly reopening at limited capacity. So as far as I can tell, most investors really are still thinking about Sanderson as a very traditional cyclical chicken stock going up and down based on the price of soybean and corn. But in fact, what I think people are missing is that this is actually a recovery play. And I think that as these restaurants are reopening, Sanderson will be extremely well positioned in 2021. Now, to make things even better, some of their biggest customers, including Arby's, which I don't know if they operate outside the United States, but it's basically like a Burger King or McDonald's. It's quite a big chain. They've announced some big promotions around chicken sandwiches for the summer. Several of the chains on the right are doing promotions around chicken wings. So there's quite a few big promotional events that will have nationwide marketing campaigns around chicken happening in the summer and the fall, which are traditionally the biggest chicken eating months in the US. You know, the weather's nice, people are outside barbecuing and things like that. So catalyst number two is I think that Sanderson is a recovery play. And I don't think that many investors are thinking of it as such. So number three, in terms of potential catalysts, is the avian flu. So obviously most of the world has been paying attention to human flu or COVID over the past 12 months. And that's kind of pushed down in the news cycle what normally would be quite a big story, which is that starting in Russia, I believe it was in late 2019, then spreading to European chicken flocks, and then later to Brazilian chicken flocks, there has been a very big outbreak of bird flu, of chicken influenza. Whenever that happens, countries start panicking. They close the borders to imports of poultry from the infected countries. Here's just three of many different headlines that you can Google. But essentially what was happening is as countries didn't want to import infected chickens and potentially spread the avian flu to their own chicken stock, to their domestic production. So they started putting in place restrictions, banning chickens from place A or place B. And at the same time, many producers started culling chickens. So you see here a headline from Sweden where they had to cull over 1 million chickens at a few particular farms to try and curtail the avian flu from exporting. It should be noticed the site on the right, the poultry site, is not the most exciting site on the internet. This is not your next Wall Street bets. I've probably spent 30 hours reading that site in the last few months trying to reach Sanderson. So I guess I'm taking the pain so you guys don't have to. Now, if you look at the global chicken production, 3 of the top 6 producers have been impacted by this flu. The United States, which along with Australia tends to have the most stringent and effective poultry and wildlife quarantine rules, has so far been unaffected. And what that's doing is, in fact, it's increasing the export opportunities for US chicken manufacturers. So right now, Sanderson exports to the Middle East, to Mexico, to South America, a little bit to Southeast Asia. They haven't announced specifically which new markets they are entering, but the CEO, Mr. Sanderson, alluded last week during the call that they have some new customers, maybe in Vietnam, is probably my guess, of countries that have basically banned the import of Brazilian chickens as a result of avian flu. So this is not a Sanderson specific catalyst, but Sanderson is very strong in the export market. So I expect this will increase the demand for its chickens this year. And finally, going back to the idea that a chicken is ultimately a result of 2 other commodities, which are soybeans and corn. Now, corn prices have been relatively stable, flat, and affordable. But this chart here shows the soybean price from the middle of December 2020 up until today. And it has increased 20%, which is a very fast growth. That is largely because of weather, um, both in the United States as well as in South America. The USDA, which is the US Department of Agriculture, has issued a severe warning about the soybean crop. They're expecting there to be much less soybean in the market. And that a similar warning is kind of going across the industry as it regards to South American soybeans. So under normal circumstances, this would actually be a very bearish kind of sign for a chicken producer, right? Because you can't increase the price of chickens by 20% to match. So most likely, a dramatic increase in the price of soybeans is going to hit the bottom line of a company like Sanderson. Now, my hypothesis, and I'm not sure if I'm right, but I think so, is that because Sanderson is the most effective and efficient producer in the industry, again, they have a 3% operating margin, is that they can maybe use this as an opportunity to gain market share from their competition, because their competition is operating on a less than 1% profit margin. So they don't have anywhere to go if the price of soybean moves up. Whereas Sanderson could conceivably say, we'll push some of that through to the consumer in terms of higher chicken prices. We will take some of that into our profit and loss as a higher cost of goods sold. But first and foremost, we're going to push this as an opportunity to win market share. And in fact, in the last quarter, Sanderson Farms already won 2 large wholesale distribution centers that were previously with a competitor, and they have become new customers. Now, they wouldn't say which competitor that was, but I believe it's actually Tyson Food that they won this from. They were 2 huge, huge distribution centers selling millions of chickens through to supermarkets around the United States. Now, there are risks, and usually when I talk about Sanderson with other investors, the first thing they say is, well, what about plant-based meats? That's plant-based meat. That's a big trend, that's the future, it's growing, and it's starting to taste less disgusting than it used to. So how do we think about this risk in regard to a poultry manufacturer? Well, on the top left is a chart. And again, it might be too small to see over YouTube, but it goes from 2017 on the left and has forecasts all the way till 2030 on the right of the general plant-based meat market. So it is currently sitting at around a $7 billion a year market. And in the investment timeframe that I'm interested in, which is probably about till 24, 25, it should grow about double to 15 billion. Now, what's interesting is if you look at the chart below, that actually has the breakdown of plant-based meats. And you see that by and large, the biggest protein that's being substituted by plant-based meat is beef, in particular burger patties. And there's a pretty good reason for that. Beef is about 10 times more destructive to the environment than chickens are. From the perspective of calories of protein consumed by carbon emissions created. So first of all, this is creating less impetus for plant-based companies like Beyond Meat or Impossible Foods to create chicken substitutes. The obvious low-hanging fruit is beef and the cattle production. And in total, just I guess I should have mentioned that to begin with, the global carbon emissions coming from agriculture and livestock is about 25% of the total. So, there's huge gains to be had by reducing beef. But even so, okay, let's say that chickens represent something like 10%, or that plant-based chickens represent something like 10% of the plant-based meat market. So it would put us at about 600 million or so of chicken substitutes, roughly speaking. We would assume that even though it's not that big yet, we would slowly start to see an erosion of chicken consumption, right? If chickens are being replaced by fake chickens, then people should be eating less chickens. However, in 2019 to 2020, domestic, so domestic being American in this case, consumption of chickens actually increased by 1.4%, despite chicken substitutes increasing by 10%. So it's actually not true that fake chickens are replacing real chickens. And uh, that's not really surprising because part of this is people becoming more health conscious. They're switching from red meats to white meats. People are becoming more ecologically aware. So they're switching from higher carbon emission meats like beef and pork and lamb to lower emission meats like chicken. So I don't see it as much of a threat. And just to kind of reiterate again, even though the whole US chicken market was up 1.4% last year, Sanderson sales were up 5%. So net 3.6% of that sales growth was at the expense of their competitors, of the enemy chickens, I guess you could say. Now, there's three other uh, kind of risks. So I think the biggest one is obviously if the avian flu were to penetrate the US borders. Um, I mean, the US is a very big country. It could be regionalized, but a lot of US chicken farming happens in those same kind of areas where Sanderson operates. So that would obviously be a catastrophe both for Sanderson and not a very good event for my copy portfolio. We've already talked about global warming and the severe weather we saw in Texas a few weeks ago. Um, I literally spent a Saturday afternoon doing research on, like, Googling, for example, at what temperature can chickens survive? And I learned that there's chickens up in the north, north of the Arctic Circle. So luckily they turned out to be okay. They bunched together, stayed warm, and yeah, lasted out the thing. Now I think the last one, which is kind of important, even though chickens from an ecological point of view are not necessarily priority number one, in the past 10 years there has been kind of occasional crusades, including the best-selling book Supersize Me, which was quite a disgusting nonfiction book that turned many people into vegetarians. There are occasional campaigns against the whole chicken industry. Sanderson has been devoting marketing dollars to kind of, I guess, pitch their view about the ethics of chicken farming, showing that they treat their chickens well. They don't do some of the more questionable practices in the industry. So in several states in the US, they released a television campaign actually and an internet, a digital marketing campaign, basically arguing the case that they're fairly ethical chicken farmers. They're not organic chicken farmers or free range chicken farmers, but that they do a pretty decent ethical job. But there always is a risk in chickens that something like this will kind of catch wind and become a very public uh, part of the thought process. Okay, so just in terms of the presentation, I tried to keep it short, but if you have questions, you can now type them in the chat, and I would be very happy to answer them. Now, I do have like a 10 or 15-second delay from you guys. So just wait for a minute, see if there's any questions. So maybe while I'm waiting for the live stream delay to come through, um, for anyone who's not aware, uh, a bunch of people copying my portfolio, we are all together in a Discord server. It's a pretty friendly community and anyone is welcome to join us. We talk about the copy portfolio, different stocks, the markets, try and answer questions when everyone has one. Yeah, I hope you found that useful. It's really tough to do a Q&A with this big of a delay. Okay, what I think I'll do, the delay is kind of too big for this to be a practical. Okay, I'll answer one question I see here. I wonder, Jeroen asks, I wonder if this will be my eToro portfolio. I just added funds without copy open positions. So first of all, I would always highly suggest that you copy open positions when you invest in my portfolio. It doesn't matter if it's a new copy for the first time or whether you're adding funds. I really recommend copying open positions because I don't trade often enough to cycle through my cash. So it might take 6 months or 9 months before I invest all the money um, without copy open trades. If you have copy open trades ticked, yes, you will get Sanderson Farms and every other stock in my portfolio. Okay, what I'll do is I'll just end the stream here. Thanks again. I hope you found it a bit useful and interesting. I know it's not a very common stock to talk about. If you have any other questions, I will be around on the Discord server. So again, thanks for participating and take care, everyone. Bye-bye.